I was reading your note. It's titled What the 10-Year Could Be Telling Us. So what is the 10-year Treasury note yield telling us, investors, everybody, about what the markets hold in the future?
It was the number one question that we got over the past couple of weeks, Dom. And we did put this piece out before the Fed meeting yesterday. I mean, you think you could have gotten, sort of whiplash kind of following things the last couple of days post that Fed meeting on the yields. But at any rate, we tried to take a step back and look at the bigger picture and say, what the heck is going on? Because I think it did confuse a lot of equity people. And the first thing that jumps to my mind when you talk to me about 10-year yields, remember, I'm an equity strategist, not a fixed income strategist. But ISM and the 10-year yield have basically been the same cycle since the financial crisis. And we care a heck of a lot about ISM because it tends to dictate a lot of sector trades within the U.S. equity market. And we went back and looked at just the move that we've seen, and we thought it was pretty commensurate with the downtick that we've started to see in the ISM. So this week, I know everybody was watching the Fed. They certainly gave us a lot to think about the other day. But we were actually watching the Empire Manufacturing Survey, and we were also watching the Philly Fed Regional Survey. And what we saw in both of those headline indicators was declines and misses in expectations. And so we think that sort of boosted in our minds the possibility that ISM is set for downdraft. So the question is, as an investor, what do you do about it? We still like cyclicals longer term, but near term, we think it makes the case for playing some of the classic defenses like healthcare, like you mentioned earlier, has been doing so well.
I mean, Lori, so I mean, when we say the word peak or trough, I mean, that's a timing mechanism. That's a timing. That means to say that things are, at least in the near term, like you said, at the top. There could be more attractive levels ahead. We've noticed that the pullbacks have become shallower and shallower since the great financial crisis. And yes, you can say central banks are part of that story. So just how deep of a pullback, even if it's short term, would it be before you expect buyers to step in to take advantage of those 4, 5, 6, maybe even 8 to 10% discounts or more?
It's a great point, and it's a great question. And frankly, I've told people I'm not sure that I would do a whole heck of a lot about this. We are sticking with our cyclical overweights longer term on things like financials. But we did look to another indicator to try to get a sense of how deep this could go, and that's looking at the rate of change in S&P 500 EPS growth, which looks like it's also probably peaking in terms of the rate of change, not the dollar level, but the rate of change this quarter. 2 of the last 3 times when we've come out of a recession and we've made that early cycle peak in S&P EPS growth, markets have been down 6 months later, very modestly, but up 12 months later. And if you look at the peak to trough move, it's been about 8-9% 2 of the past 3 times. So in my mind, that's the kind of decline we might be looking for here. Not characterizing the entire second half of the year, but a good old swing lower, just sort of down at about that level at some point during the course of the second half.
So Lori, when you're putting your models together and trying to put valuations into the mix here, you mentioned that there's a possible deceleration, not a total annihilation of earnings growth, but it's just not going to grow as quickly anymore. There are those that argue that the markets right now are bubblicious, maybe even overvalued, maybe stretched to the upside. Do you believe that the market is stretched right now, given what you think earnings will do acceleration-wise in the coming months?
So I think that, we are definitely at sort of the top of the end of the PE range. I mean, it depends on what metric you look at. And frankly, most asset classes are overvalued these days. So I don't know that equities are necessarily that worse off than others. But if we look at a PE multiple, we've been baking into our 43.25 target this year, a 21.6 times PE multiple at year end based on, some fairly conservative relative to the, other strategists, at least, earnings numbers for next year. So I do have a pretty high multiple baked in at the end of the year. I have a hard time really seeing any further expansion beyond that, just given, kind of where we are in the cycle and some of the pressures that we see coming down the pike. But look, I do think valuations just from a bottom up level are a reason to be concerned. We talk to a lot of investors who get sticker shock. Stock pickers who do nothing but pick stocks are still struggling with valuations. And so I do think that creates some downward pressure. One of the things we've told people is if you really want to play defense in the short term, you do need to think about valuation a little bit here. And so we like something like healthcare in the short term, which is giving you some really tremendous valuation appeal at this moment in time. I'm much more wary of something like technology, which has recently become the second most overvalued sector in the S&P 500 again. And I will tell you, investors care about valuation in a way that they did not in the past. So I do think you have to take that concern seriously.
Well, certain investors do, maybe not the meme stock investors or maybe in certain crypto areas of the market. Lori, I'm also wondering, from your standpoint, are there any tea leaves that you look at, leading indicators perhaps, parts of the equity market that you think could signal things? We've talked in the past about transportation stocks and companies doing that kind of thing. We've talked about semiconductor stocks being that kind of an indicator. Are there things that you are keying on right now, certain industry groups that you say, hey, you should pay attention to these? They could be a leading indicator.
I would say, we always watch the banks very closely. And, after the Fed announcement the other day, we did get a nice move in the financials that clearly faded. But I do think we can watch the financials as a bit of a barometer because ultimately they should benefit from higher short-term rates. So we can keep an eye there. But I'll tell you the one thing I'm watching, I'm an old small cap strategist. I still love to watch the Russell 2000 relative to the S&P. And we did see, some flattening out in the Russell starting basically around March when the bond yield started to trade sideways. And we've seen a decent amount of stability there, though. So I think that small caps were sort of pricing in very early on some of the slowdown in this rate of change. They were pricing in some of the margin pressures that were coming. And I think small caps have the ability to sort of give us a clue, once we kind of made it through, kind of this, I don't want to say precarious, but this more sort of, wary, sort of a nefarious, little moment we're having in the market here. I think they'll give us a good clue when things are on the upswing again.
Shepard Smith here. Thanks for watching CNBC on YouTube.